Accounting principles, concepts, and qualitative characteristics. Introduction. Welcome to accounting principles, concepts, and qualitative characteristics that form the foundation of financial reporting. Accounting principles and concepts ensure financial statements are consistent, reliable, and comparable. These guidelines govern how financial transactions and statements are recorded and reported. Understanding these fundamentals is essential for accurate financial reporting. Key accounting principles. Let's explore the fundamental principles that guide accounting practices. Core principles. Accruals principle recognize revenue and expenses when they occur, not when cash is received or paid. Consistency principle use same accounting methods in each period for comparability. Going concern principle assume company will continue operations in foreseeable future. Prudence principle avoid overstatement of income/assets and understatement of expenses/liabilities. The accruals concept. The accruals concept is fundamental to modern accounting. Revenues and expenses are recognized when earned or incurred, regardless of cash timing. Example, service provided in December but payment received in January. Revenue is recognized in December when service was rendered. Formula, revenue recognized when earned equals service provided. This ensures financial statements reflect actual business performance during specific periods. Going concern concept. This concept assumes business continuity. Company is assumed to continue operating for foreseeable future. Financial statements prepared assuming no immediate liquidation. Example, company with large inventory assumes it will sell goods in future rather than recognizing immediate liquidation losses. Affects asset valuation and liability classification in financial statements. Consistency principle. Consistency enables meaningful financial comparison. Once accounting method is adopted, it should be consistently applied across periods. Enables comparability of financial statements over time. Example, if company uses straight-line depreciation method, it should continue using this method in future periods. Changes require disclosure and justification. Prudence concept. Prudence ensures conservative financial reporting. Revenues should not be recognized until realized. Liabilities should be recognized when obligation is known. Prevents overstating profits and assets, understating expenses and liabilities. Example, when uncertainty exists about debt collection, allowance for doubtful debts should be made. Matching concept. The matching concept links revenues with related expenses. Revenues and their related expenses should be recorded in same period. Ensures accurate measurement of periodic performance. Example, company earns revenue by selling goods. Cost of those goods, cost of sales, should be recorded in same period as revenue. Creates accurate profit measurement for specific periods. Entity concept. This concept establishes business as separate entity. Business is separate entity from its owners for accounting purposes. Personal and business transactions must be kept separate. Example, owner's personal expenses should not be recorded in company's financial statements. Ensures clear distinction between business and personal finances. Money measurement concept. Only monetary transactions are recorded. Only transactions measurable in monetary terms are included in financial statements. Example, company's reputation or employee skills cannot be measured monetarily and thus excluded from financial statements. Provides objective, quantifiable basis for financial reporting. Limits scope but ensures verifiability. Historical cost concept. Assets recorded at original cost. Assets should be recorded at cost at time of acquisition, not adjusted for current market value changes. Example, building purchased for $500,000 recorded at that cost regardless of market value changes over time. Provides objective, verifiable basis for asset valuation. Realization concept. Revenue recognition timing. Revenue is recognized when earned and goods/services have been delivered. Example, sale is recorded once goods are delivered to customer, even if payment received later. Ensures revenue recognition reflects actual business performance. Links to accruals concept for complete transaction recording. Qualitative characteristics overview. Qualitative characteristics ensure financial information usefulness. Key characteristics. Relevance influences decision-making. Faithful representation, complete, neutral, error-free. Comparability enables comparison across periods and entities. Verifiability, confirmable by independent parties. Timeliness, available when needed for decisions. Relevance. Information must influence decisions to be relevant. Information is relevant if it can influence user decisions. Must help users make predictions or confirm prior expectations. Example, recent company performance information is relevant for investment or lending decisions. Irrelevant information clutters financial statements and reduces usefulness. Faithful representation. Information must accurately represent economic reality. Key aspects. Complete, all necessary information included. Neutral, information should be unbiased. Free from error, no mistakes in data presented. Ensures users can rely on financial information for decision-making. Builds trust and credibility in financial reporting. Comparability and verifiability. These characteristics enhance information usefulness. Comparability. Users should be able to compare financial statements across time periods and with other companies. Consistent application of accounting policies helps ensure comparability. Allows identification of trends and performance differences. Verifiability. Information should be confirmable by independent parties such as auditors. Enhances credibility of financial statements. Provides assurance to users about information reliability. Timeliness. Information must be available when needed. Information should be available in time to be useful for decision-making. Example, quarterly financial reports help investors make timely decisions. Delayed information may no longer be relevant for decisions. Balance between timeliness and accuracy is crucial. In this video, we've explored the fundamental principles and qualitative characteristics that guide accounting. Accounting principles ensure consistent, reliable financial reporting. Concepts like accruals, going concern, and consistency form the foundation of accounting practice. Qualitative characteristics ensure financial information meets user needs. Understanding these fundamentals is essential for integrity in financial reporting. These principles and characteristics work together to create a framework that produces reliable, relevant, and useful financial information for stakeholders.